Welcome back. It's JWalter here. Obviously, there's been a lot of talk regarding spiking mortgage rates. Rates have increased approximately 2 percentage points in just this year alone. And of course, we have record high home prices right now as well. So there's been a lot of talk about how home prices may decrease later this year, or there's going to be this housing market crash. So I actually did some digging for you guys, and I found an interesting article on fortune.com. In this article, they state the cities that are at the biggest risk of home prices decreasing over the next 12 months. Because as I always say, every housing market's different in the US, right? So let's go ahead and dive right into the video, and hope you guys get a lot of value out of today's video. Also consider subscribing if you haven't done so already, and I'll give you the latest housing market updates across the United States. So this is an article according to fortune.com that was actually just published yesterday at the time of this video. It says the odds of a home price decline hitting your local housing market as told by one interactive chart. So let's go ahead and dive right in here. So basically right now, the Fed is announcing that they're going to be increasing the federal funds rate at each of their meetings this year. So there's a lot of talk right now that the Fed may increase the federal funds rate by 50 basis points in about a week, just a little bit less than a week. And they're basically doing this to target inflation, right? So inflation's at basically 40-year highs. They're going to be increasing the federal funds rate to wind down the inflation rate. So it says right here that the Fed's plan is to put upward pressure on interest rates until price growth relents. So right now the street is forecasting for a 50 basis point increase by a probability of 96% at their next meeting, which is in 6 days from now on May 4th. In any case, because the Fed has announced they're going to be raising rates at practically every single meeting this year, there's a lot of talk regarding how that's going to affect the housing market, because the increase in the federal funds rate has an indirect effect on mortgage rates. It's not a direct correlation, but it can increase mortgage rates. And that's one reason why we're seeing mortgage rates increasing greatly so far this year. So in other words, they say here that spiking mortgage rates can quickly price out home buyers. And this is already starting to happen. So I actually have some notes right here. So the slowdowns we're personally seeing right now, or the early signs of a housing market slowdown right now, is that we're seeing a decrease in pending home sales, a decrease in existing home sales, and also a decrease in the number of new home sales in the US. And this is thanks to some new reports that were actually just released this week, actually. In addition to that, we're seeing a decrease in the amount of purchase applications for loans. So people are looking to get a loan to buy a house. We're seeing a decrease in the numbers of people doing that. On top of this, Redfin announced they're seeing a reduction in the number of home showing requests by Redfin agents as well, and they have an index for that. So anyways, we're starting to see some early indications that our housing market is slowing down, and this is due, of course, because mortgage rates have been increasing greatly, and we're not seeing a reduction yet in home prices. So one reason why we're seeing a slowdown because of mortgage rates is this example right here. So it says a borrower who took out a $500,000 mortgage at a 3.11 rate about 1 year ago, that would give you a principal interest payment of $2,138 per month. But at a 5.18% rate, that monthly payment on a 30-year fixed rate mortgage spikes to $2,718. So in other words, a difference of about $600 on a $500,000 mortgage, just because mortgage rates have increased approximately 2 percentage points in a matter of 1 year. So the most recent data we actually have for Freddie Mac, and by the way, Freddie Mac announced average mortgage rates on a weekly basis. So they actually just announced this morning that the average last week was actually 5.10%. And I thought the chief economist of Freddie Mac had a really good quote here regarding how these rising mortgage rates are impacting our housing market. And then I'm going to get back to this report from Fortune and tell you the cities that are at the greatest risk of home prices decreasing here. So anyways, Sam Cater, who's Freddie Mac's chief economist, said the combination of swift home price growth and the fastest mortgage rate increases in over 40 years is finally affecting purchase demand, as we can see there in mortgage applications and also home sales as well. Home buyers navigating the current environment are coping in a variety of ways, including switching to adjustable rate mortgages, moving away from expensive coastal markets, and looking to more affordable suburbs. We expect a decline in demand to soften home price growth to a more sustainable pace later this year. Important to note there, he said soften home price growth. He didn't say that home prices are going to be decreasing, but he's saying that home price growth is going to be decelerating. Important to note here too, as well, is that he says an increase in the amount of people using adjustable rate mortgages. If you missed my previous video from yesterday or 2 days ago, Have a look at that because the share of people using adjustable rate mortgages has basically doubled in the past 3 months, which is a big risk in my opinion, a big red flag in my opinion, because the rate on adjustable rate mortgage is about 1% less than a 30-year fixed rate mortgage. And therefore, because people are getting priced out, they're using the more risky adjustable rate mortgages here. And by the way, if you guys want me to make a separate video about my personal opinions regarding adjustable rate mortgages, then leave me a comment below and I can provide some insight regarding that, or at least provide you my opinion regarding that. So in any case, because we're seeing these rising mortgage rates, some home buyers are getting priced out of this market. If their housing payment's going to be increasing, some people, it may increase to an amount that they no longer qualify for the loan. And that's one of the big risks, in my opinion, about putting a deposit down on a dirt lot. It went on to say the following in this report here. They're basically seeing mortgage rates increasing, and that's obviously putting downward pressure on our housing market, but it does not mean home prices are about to crash. They basically state here that Fannie Mae and Zillow and a lot of other companies are saying that home prices are going to be increasing overall over the next 12 months and also this year as well. We'll have to see about that. However, they say a chance that the economic shock caused by soaring mortgage rates could see home values fall in some overpriced markets. And it says here, to understand which regional housing markets in the US might see a price decline, Fortune actually reached out to Corelogic. I make a lot of videos about their reports. I'm from Corelogic here. Anyways, they reached out to Corelogic and asked them which markets are at the biggest risk of home prices decreasing. This is an assessment of close to 400 metro areas across the United States here. So here's how they did it. Corelogic put housing markets into one of 5 categories based on the likelihood that home prices in that particular market are about to fall or are going to fall over the coming 12 months. And here's how they grouped it. Elevated meaning over a 40% chance of a price dip, high with a 30 to 40% chance, medium 20 to 30, and then down to very low with a 0 to 10% chance of home prices declining over the next 12 months. So here's a graphic depiction showing the odds of home prices decreasing over the next 12 months. So the dark blue lines mean very low. Again, a 0 to 10% chance of home prices decreasing over the next 12 months. In contrast though, elevated, again, that's over a 40% chance, are in red there. When looking at this graphic here, you can see in California, at least for Central California and Southern California, we have a low probability, whereas in Florida, much of Florida, there's a very low probability. In contrast though, there's other markets like Mount Vernon, Washington, Salem, Oregon, and also Hartford, Connecticut as well, that had elevated levels, again, over a 40% chance of prices dropping over the next 12 months. So let me share the actual cities itself here. So it says among the 392 regional housing markets that Corelogic measured, it puts 86% into the very low or low likelihood of a price decline. It puts 10% of the markets into the median grouping. Medium, of course, means a 20 to 30% chance, and only a 1% in the high grouping. In addition, they only place 2% of the markets into the elevated group, where they see a chance of prices declining by 40% there. And those cities are Hartford, Connecticut, Kalamazoo, Michigan, Lewiston, Maine, Mount Vernon, Washington, Muskegon, Michigan, Olympia, Washington, Salem, Oregon, and Honolulu. So it goes on to say in this report here that even though we're seeing these soaring mortgage rates, Corelogic still thinks the chances of home prices overall in the US declining in 2022 is very low. And they cite the mismatch between inventory and demand. Obviously, we have much more demand than inventory right now. We'll have to see that changes though. But that's why Corelogic is forecasting for home prices to increase by 5% this year. And that's reflected in their national forecast due to the imbalance between demand and supply. In any case, it's important to note that even though Corelogic is forecasting for a 5% growth, that is far different compared to the last 12 months. According to Corelogic, over the last 18 months, home prices have increased 19.8%. So if home prices only increase 5%, that's a big, big decrease. However, this does not mean that Corelogic views this housing market as healthy. And I would agree with them regarding this because in my personal opinion, this housing market is very unhealthy because of the lack of affordable houses. And of course, because spiking mortgage rates are causing affordability issues for a lot of home buyers out there right now. And of course, we still see this imbalance between demand and supply as well. I really hope that changes in the favor of buyers here soon though. We'll have to see. So speaking more about housing affordability, Corelogic actually did some digging regarding this. So they also calculated whether local income levels could support local home prices. The finding was that Corelogic said that 65% of US regional housing markets are overvalued. And that includes every major market in states like Arizona, Florida, and Texas. Just 9% of regional housing markets are what Corelogic deems to be undervalued, and compare that to more normal levels, that actually should be at 26%, not 9%. So the vast majority of the housing markets in the US, at least according to Corelogic, are deemed to be overvalued. So have a look at this graphic here. So the areas in red is what Corelogic deems to be overvalued. And there's a lot of overvaluation in, look at Arizona and also Florida, for example, a lot in Oregon as well. I'm surprised to see that. In stark contrast, the items here in blue are considered undervalued, and we have barely any areas. Chico, California is undervalued. San Jose, undervalued. I'm surprised to hear that. Also, San Francisco and Oakland also considered to be undervalued. Really surprised to hear that as well. A bunch of other cities here, but as you can see here in this map here, the vast majority are deemed to be overvalued. Some other areas that they deem to be overvalued are Riverside, California, a lot of counties within Arizona, Flagstaff, Prescott Valley, Phoenix, Arizona, Las Vegas as well. And looking over here, we have Reno, Nevada, a lot of the coastal markets here in Oregon, like Salem, Oregon, and also the coastal markets here in Washington as well, Seattle. And then Sacramento also deemed to be overvalued as well. Interesting to see that. As well as Salinas, California, which is right next to Monterey. Also interesting to see that Santa Barbara is also deemed to be overvalued, which is interesting to see because home values in Santa Cruz, for example, have been increasing at a greater rate compared to Santa Barbara. And right now, the average home price in Santa Barbara is around $1 million. So they're considering that to be overvalued. I'm guessing that's due to the lack of high income jobs in that area there. We're also seeing a lot of red here in Utah as well, Salt Lake City, and also in Denver, Colorado Springs, Pueblo, Colorado as well. Also interesting to see that San Antonio, Texas was deemed to be overvalued, as well as Austin, Texas as well. At the end of this article, it had a really good quote here. It said, increasingly, insiders to the real estate market are rooting for spiking mortgage rates to rein in the unsustainable levels of home price growth. I would also love to see that as well. That includes Logan, who is the lead analyst at housingwire.com. He'd like to see soaring mortgage rates cause some home buyers to pause their search. I believe we're seeing that already, but let's hope that we are seeing more of that to increase housing inventory. So it says if that happens, inventory could finally get the breathing room it needs to rise again. It's too many people chasing too few houses. We desperately need a breather. I couldn't agree anymore. We definitely need to see a more normalcy in this housing market to give home buyers a better shot at buying a house without having to write offers way over asking and to compete against 10 other buyers for the same house. So I hope you guys got a lot of value of today's video. If you did, please hit the like button. I greatly appreciate that. Also consider subscribing if you haven't done so already. Hope you have an awesome day and look forward to seeing you on the next video.